Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Will Rhind. He's the founder and CEO of GraniteShares. We're going to take a look at single stock ETFs and what they are most useful for. It is great to have you back with us at MarketSite.
Thanks
for joining us, Will. And single stock ETFs, it's a pretty interesting product. Tell us more about that. What's your outlook on these?
So this is a really new category of ETF for the US market, but it's actually been around for a few years in Europe already. So in the US market, people have been able to get leverage on your broad equity indices, broad bond indices. Now you can make that much, much more targeted with leveraged and or short exposure to individual companies. So allowing people to take conviction views on companies like Tesla, for example, both on the long and on the short side.
So how is it levered? Is it 1.5 times, 2 times? How does the leverage work with it?
Yeah, so typically the leverage is determined by the stock itself. In other words, the underlying volatility of the stock, but they're no more than 2 times leverage. But most commonly, you'll see leverage around 1.5 times that of the underlying stock. So
what are these useful for? Are these speculative instruments? I mean, can they be used for hedging? It sounds like it might be more for the speculative type of trader.
Yeah, I think if you're clearly on the long side and you're using a leveraged instrument of any kind, you can use that for speculative purposes. In other words, if you have a bullish view on a particular stock around earnings, then using a leveraged ETF is one way to do that versus sort of traditional leverage techniques. However, there are all sorts of other ways you can use ETFs, and particularly on the short side, like you said, they can be used for hedging purposes where people perhaps don't want to sell their underlying stock if they're long a particular company and have been for some time. In other words, they don't want to generate a taxable event. Using a short, if there's a negative short-term view, could be a way to go around that.
Let's talk about some of the GraniteShares single stock ETFs. You have this on, one of them is Tesla, as you had mentioned before. What does this look like under the hood? What's contained in the ETF wrapper?
Yeah, so the ETF provides leverage exposure and or short exposure to Tesla. So on the long side, the underlying ETF ticker is TSL, and that provides 1.25 times the daily movement in the Tesla stock price. TSLI, TSL inverse, that is the short version of that, so it provides 1 times the underlying move of Tesla. Obviously, if the underlying goes down by 5%, the idea of TSLI is to go up by 5% in a day.
Why not just short the stock, if I understand this correctly?
Yeah, so traditionally getting access to other forms of leverage and or even shorting techniques has kind of been the preserve of very specialist investors, such as hedge funds. Hasn't really been accessible to the broader market. One of the reasons for that is actually it can be very dangerous to do that. So in shorting, for example, you're borrowing a stock from a counterparty and then selling that short in the market. So it does expose you to potential unlimited losses if that goes against you. Whereas with a short or a leveraged ETF, the maximum you can lose is the value of your investment. In other words, you can't lose more than the value of your investment. So it's a safer way to implement some of these particular strategies.
So if you, say for example, buy the short Tesla ETF, right, TSLI, $100 is your cost. That is the maximum that you could lose versus, say, stock XYZ going from 200 down to 0, which hypothetically it can. So that's kind of where, that's how that plays out.
Correct. So the basic principle with borrowing money and in any derivative strategy when you're leveraged is that you can get losses that exceed the initial amount of your investment. And so that's something clearly that you want to avoid if possible, and that's why traditionally that's really been the preserve of specialist investors such as hedge funds. But that's why you read some of these stories about hedge fund investors, for example, losing huge amounts of money, and it makes the news is because they have really exposed themselves to huge losses by being wrong on a particular short call. And that's something that even if you get the direction wrong with a short ETF, you're limited to the amount of your investment.
It sounds like it would be more cost effective too, because sometimes borrow costs can be, especially on thinner stocks, can be quite expensive.
That's right. It's not only about the borrow costs, which can be huge, and sometimes the brokers won't provide access to certain stocks at certain times, but it's also about the consistency. In other words, being able to buy and sell that during market hours. And sometimes it's not just a case that the borrow might be particularly high, but it might also be unavailable. And so by packaging that up in an ETF, makes that available to investors on a daily basis.
Are you seeing traction with these?
Yeah, we are. I mean, obviously, it's a tough environment,
Right.
both on the long and the short side, because the market's been very volatile since we launched about mid-August. But certainly starting to gain some traction around these names. We have a long Coinbase ETF, for example, and that particular ETF has gathered quite a lot of traction because it's the only sort of leveraged proxy play on cryptocurrencies, if you accept the underlying Coinbase stock as a proxy for crypto.
All right, interesting. Appreciate the insight, Will. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.